one of the issues facing public employee retirement systems, and really all defined benefit systems, is whether or not in today's low interest rate environment, returns on assets will be adequate to support benefits. If we look back over the past 3 decades, while we've had a pretty challenging period with the global financial crisis, in the total return over that time period, funds, well-diversified funds, well-managed funds, have averaged around 11% just on a passive basis from the capital markets. That's certainly greater than anticipated. We do think that, therefore, assets have achieved the goals that have been established for them over that time frame. When we do our assessment of what's available in the capital markets, we look forward and forecast over the next 20 years. Based on our forecast for a well-diversified program globally, we think those returns are eminently achievable, with returns in the 8% range possible. Even with a premium for active management, you could possibly do better than that. We certainly believe that return expectations between 7 and 8% are eminently doable. We are certainly living in a lower interest rate environment. In that environment, it's unlikely that you'd get appreciation in your fixed income portfolio because of rates declining, because they already have declined fairly dramatically. So that means that in your fixed income portfolio, you have to really consider what is the role of fixed income. Can you take more credit risk? Can you move more globally in order to increase the rate of return and the income level that you get on your fixed income portfolio? We think in this kind of environment, it's still important to have a well-diversified investment program, particularly outside of the traditional asset classes. So using hedge funds, using alternative investments like private equity, thinking about inflation hedge investments that also can generate income like infrastructure, like timber and agriculture. All of those ideas are ways to mitigate the environment we're in right now, the low interest rate environment. We think the important message here is that in the pension math regarding investments and their contribution to the overall success of a defined benefit pension plan, we believe that the notion is that investments can do their part. Contributions are required in order to support most DB pension plans, but the investment piece we think is a solid contributor to success, and that should provide comfort to both the sponsors as well as the employees involved in defined benefit pension plans.